In today's video, I'm going to show you why credit matters and also when it doesn't matter. We're going to look at what it would be like to pay a car loan over 5 years with good, average, and poor credit. I'll show you the difference in money that you'll spend based on your credit score in those three situations. All right, I love this tool when it comes to figuring out how much interest we're going to pay on loans over time. So it's a loan payoff calculator from Money Under 30, and I'll link to it below. But basically just come here. It's really simple to use. So we're going to use some average rates and round numbers to just get you to see the difference in having poor credit, average credit, or good credit, and what that's going to cost you over time on something like a car loan. Same thing with credit cards and home loans and all of that, just the thought of getting a better rate versus not, right? So let's look at a $20,000 car. I would come in here and put your own car, like how much you're gonna buy or pay or how much you're currently paying. But I'm just, for round numbers sake, gonna use $20,000, which I think is about an average price for a car. And I definitely do not recommend getting a $20,000 car if you're working on your finances. Take a look at my video on how to get out of an upside down car loan. I'll link it here or show it here if you want some help on more info on this car specifics. But I'm by no means recommending getting a car loan this size or anything if you're working on getting to a good financial place. But just, we're talking about credit here. So let's take a look. So $20,000, we're gonna first look at good credit. So my husband and I, on our loan, we pay 1.9, I think, 1.99. So I'm gonna put 2%. This isn't our loan information, but I'm gonna put 60 months, $20,000, calculate. So if you had really good credit and you would pay $1,000 over the course of a 5-year loan. So that's where what I was talking about, like, I don't fully believe in the debt-free life if you have good credit and get good rates on your loans that you do take out, because instead of paying off our car, we invested the money instead, because at 2% we feel like we can make more than that, and we have definitely made more than that in the stock market. But that is another video. So let's now look at if you have a 10% score, which is, I read, a typical score for people to, or a typical rate that people are getting, and then 9%, and then calculate. So going from $1,000 at a low rate to now you're spending $5,000 over the course of 5 years. And if you have a higher rate, like a 20% rate, then you're going to spend an additional $11,700 on your car loan over 5 years. That's enough to buy a whole brand new car or a whole other car. So this is why it's so important to have good credit when you're wanting to take out a loan, and when you're figuring out if you're going to pay off a loan. You want to get this stuff with this high interest paid down quickly. Otherwise, a lot of your money is just going to the lender instead of building long-term wealth for yourself or sending you on vacations or anything. With $11,000 or say $10,000, the difference of what having good credit and poor credit is, that's a vacation. That's like a lot of vacation, you know? So just think of the opportunities that you're missing out on if you're not taking care of your credit and being aware of that. And if you're deciding to put something on credit versus saving up and paying for it with cash or working on your credit score and all of those things. Run these numbers yourself. A lot of people that I talk to don't know what interest rate they're paying. They don't know how long they're paying their debts. So that's where the lenders win. And I want you to take control and have a good financial life and keep the most money in your pocket that you can, or invested or saved up for your future, so that you can just have a better lifestyle and buy the things and experiences that you want and give to the charities that you want to be involved in much more freely without stress. So on that note, I'm going to link this calculator below. Plug in your numbers and see what they look like. It is really valuable to have knowledge on your side. All right.
Credit is one of those things that most of us mess up before we even realize what's happening, because unfortunately, this isn't taught in school, or at least it wasn't back in my day. I hope it is now. I don't even know, but I know that a lot of people are asking me, like, how do I even go about fixing my credit score? So we'll touch on that in this video as well. Credit is a numerical way to determine how much of a risk you are to a lender, and they use this number to figure out what interest rate you're going to pay based on how much risk you are to them. Your credit score is a way to let others know if you can be trusted with borrowed money and how risky it will be for them to lend you money. Based on how risky they feel you'll be is what determines that rate that you're gonna pay, and they use your score to help determine that. So there's a lot that goes into your score. It's a difficult thing to kind of get on top of unless it's something that you've been working on from day one. And if that is the case, you probably had parents that helped you with it, or maybe just learned it from somewhere, or you're watching this learning it now. So anyway, let's get into some of why it matters and what you can do to fix it if you've already ruined it, or if you've already messed it up, or just haven't established any yet. If you haven't established credit yet, meaning you haven't taken out any loans, don't have any credit cards or anything like that, then you're not going to have a credit score, or you're not going to have enough credit to show that you're a reliable person to lend money to. In that case, you're going to need to open up a card or take out some loans, like a car loan, or put some things on your credit report, like your cell phone or your utilities. And I believe you can do that through Experience Boost program, and I'll link to that below. There's things that you could link onto your credit report so that it can start tracking you as a human being that has payment history. Another thing you could do is take out a secured credit card. So you'll need to visit your bank for this or look online. And typically what they'll do is say you'll need $500 or $1,000 put in a dedicated savings account that's still your money, but it's held as collateral for a bank to give you a credit card. And so they'll give you a $500 or $1,000 limit on that credit card. And over a year's time, if you make payments on that and just keep it in good standing, then you'll qualify for a regular credit card. Those are a couple of things that can help you build credit initially. And let's take a time out and talk about why credit is even important. And we talked about it being a risk to lenders, but if you don't plan on borrowing money, meaning for a car or a house or a student loan or something like that, you might not even need credit at all. And that's when your credit score is pretty irrelevant, because if you don't need to borrow money, so if you're part of the debt-free community or really practicing that debt-free lifestyle, saving up for everything before you buy it, then you don't need a credit score. It doesn't matter if you have one or if you have one that sucks. It doesn't make any difference. The only reason you need a good credit score is to borrow money. In most cases, sometimes it is tied to a job though. Like I worked at Morgan Stanley and E-Trade and Schwab, and I believe they pulled my credit to make sure that I'm not gonna do anything shady and weird with client accounts. Because if I had poor credit, they might see that I'm a risk and more likely to do something shady. So it could be tied to getting a job. In that case, it could be very important. So I would definitely recommend working on your credit and having good credit, but you might not need it if you are part of that debt-free lifestyle. I am not, my husband is not, because we believe using debt wisely is very smart for us, because we're able to invest the money and borrow at really, really low rates because we both have good credit. So instead of paying for things in cash that we could pay for cash, we decide to keep that money invested in the stock market and then borrow money to do things like buy a home or buy a car. But that's not for everyone. If you get sick to your stomach thinking about debt or being in debt, then definitely don't follow this. I will do another video on how to use leverage to your advantage, but today we're talking about credit score, and so that's for another one. So be sure to subscribe if you're new here, and you will see that video coming out later. But having good credit is really important to get good rates so that you can just keep more money in your pocket and spend way less over time when you are doing things like having a car or a home. And that money will add up a lot over time. If you have bad credit, I have been there too. So I just want to let you know that it is something that you can fix, but you can't fix it overnight. There's no quick fixes. So it's something that you just have to start working on. And the first step is going to be to pull your credit report and see what the negative factors are on there. Those are the things you're going to want to work on. If it's lack of credit history, well, that's something that you just kind of need to work on making good payments, and over time your score will increase. If it's missed payments, late payments, or outstanding debts that you owe, make sure that you start working on paying those debts back. That's going to be the biggest, best way to improve your credit score. And a lot of people will have some things on there like an old doctor's bill or an old credit card or something that they just kind of forgot about or don't want to face because either it's too expensive or it's just a lot and you'd rather it just disappear. It's never going to disappear. Actually, I don't know if it falls off after 7 years or not. I'll have to look and put that in the notes below. You're just going to have to face your debts and take care of them, even if it's a large amount. If you break it up and start making payments, eventually it's going to improve your credit score and you're going to be so glad you finally took care of it, versus sitting on that debt for a really, really long time and never handling it and going through life with crap credit and always paying high interest rates. That's a really fast way to keep you broke for a long time because you're paying people a lot of money, so you're not able to save money, and it's just this cycle that people get stuck in. So I really encourage you to face your debts and face your negative factors on your credit report and deal with them and fix them, and your score will improve. And it'll actually start improving a lot faster than you realize. If it's a late payment or a missed payment, that's something you're just gonna have to wait out. Sometimes it happens by accident. It's happened to me. I had really good credit and then I missed a payment for 2 months because it was an old credit card that I had not been using, that I had out of mind, but it was on an old website that I didn't realize when I placed an order, it automatically went to that credit card instead of my new card. And then I went to India and I was gone for 2 weeks when they were like constantly calling me. And anyway, it hurt my score. It dropped it like 100 points. A lot. It went from like the mid 700s to the mid 600s and I was like about to be in tears. But I realized it was a mistake and I didn't need my credit for any reason at that time. I wasn't borrowing any money. I wasn't buying a car, a house, etc. So I just like went on with making my normal good payments and keeping everything in good standing. It's completely recovered. It's in the 780s, I think, right now. So it's fine. Things like that happen. The credit bureaus understand that too. They can tell if it was like a blip, like a mistake, or if you're just a repetitive late payer, then they might ding you more for that because they're gonna say, well, you're gonna be a risk to somebody if they lend you money because you always make your payments late. Set your payments up on auto pay if that's a weakness of yours. It was for me for sure. I definitely overdrafted my bank account lots of times back in the day when I was like figuring all this stuff out. So I know it happens. It's a normal part of life, but all we can do is learn and grow from that. So let me know in the comments below if you have any specific questions, and take a look at my playlist for debt and different things like that, because those can help you further increase your income, decrease your expenses, and work on other things in your financial life that will help with your credit score and your overall financial health. Remember to subscribe if you're new here, and I will see you on the next one. Bye.